If foreclosures were really back, you'd expect panic. Crashing prices, nonstop breaking news, another 2008 all over again. But that's not what's happening. Instead, something much quieter is going on. Foreclosure activity just reached its highest level since 2019, while prices in many areas remain high and inventory remains tight. In this video, we'll break down what the new foreclosure numbers actually mean, why this is happening now, and how it could affect you as a homeowner, a buyer, or an investor in 2026. Let's get into it. In 2025, lenders started some kind of foreclosure process, default notices, auction dates, or bank takeovers, on about 367,000 properties across the country. That's roughly a 14% increase from 2024, and the highest number we've seen since before the pandemic, although still far below the 2008 to 2009 crisis peak. No, this is not another Great Recession, but saying it's not as bad as last time misses the real point. What actually matters is this. Foreclosures are rising again. They've been trending up for months in a row, and they're rising while many home prices are still elevated. In November 2025, there were around 35,000 properties with foreclosure filings, up about 21% from a year earlier. December was even stronger, with nearly 45,000 filings, about 57% higher than the previous December. That's not just a calm return to normal. That's real pressure building under the surface. If prices are still high, why are people losing their homes? Most people hear foreclosures and instantly think price crash. Home values fall, people owe more than the house is worth, they walk away, and foreclosures spike. This time, the pattern looks different. In a lot of markets, prices haven't crashed. They've cooled a bit or flattened, but they're still well above pre-2020 levels, and yet foreclosures are still climbing. That tells us something simple. The problem isn't just what homes are worth. The problem is that those homes now cost more per month than people earn. Your house value lives on paper. Your mortgage, taxes, insurance, and utility bills live in your bank account. If your income is stable and your monthly costs are manageable, you can ride out a lot of price swings. But when income feels shaky and expenses keep rising, it doesn't matter what your Zestimate says. If you can't make the payment, you can't make the payment. That's where a growing number of households are ending up. Now let's talk about the thing that actually pays the mortgage, your paycheck. On the surface, the job market still sounds okay. The unemployment rate isn't exploding, and you'll often hear lines like, the labor market is still strong. But when you look at what really happened in 2025, the picture changes. The US added only about 584,000 jobs for the year, making 2025 the weakest year of job growth in more than 2 decades, excluding recession years. At the same time, companies announced more than 1 million layoffs, with job cut announcements hitting their highest level since the pandemic era. So you have fewer new jobs being created and many people being laid off, even if they later find other roles. Most households don't have 6 months of expenses sitting in savings. If someone in the home loses their job even for a few months, there usually isn't much cushion. The mortgage is still due. Property taxes are still due. Insurance drafts straight from the account. Utilities don't wait. A house with great equity doesn't help if you can't cover this month's payment. So when you see foreclosures creeping up while prices are still high, it's usually not a housing problem first. It's an income problem that shows up in the housing data. Even if your income hasn't dropped, the cost of owning a home has been climbing. Let's look at the 3 big cost drivers: property taxes, homeowners insurance, and repairs. Across the country, property taxes have moved higher. Between 2021 and 2023, the typical property tax bill rose more than 10% on average, and in many hot markets, it was closer to 20% or more in just a couple of years. Think about places like Tampa, Dallas, Jacksonville, Atlanta, Miami, San Diego, and Seattle. Several of these metros saw increases in the high teens or low 20s. If your tax bill was $4,000 and it quietly turned into $4,800 or $5,000, that's like adding another car payment to your budget without buying a new car. Then there's homeowners insurance, which has become a serious pain point. Nationally, the average yearly premium is now about $2,424 for a standard policy with $300,000 in dwelling coverage. But in some states, especially Florida, Louisiana, parts of Texas, and other high-risk areas, typical premiums are now in the 5,000 to 6,000 plus range and still rising. On top of that, deductibles have shifted higher. More homeowners are carrying deductibles of $2,500, $5,000, or more, which means they're paying more every year while still having to come up with a big chunk of cash when something goes wrong. It's like paying for a safety net that's been lifted higher off the ground. Finally, repairs and basic upkeep are more expensive than they used to be. Labor costs more. Materials cost more. In many regions, extreme weather is damaging roofs, HVAC systems, and exteriors more quickly than before. If you don't have that kind of money sitting around, one big repair can snowball into missed payments and eventually foreclosure. Now, let's look at where foreclosures are hitting hardest. In 2025, some of the highest foreclosure rates showed up in Florida, where roughly 1 in every 230 housing units had a foreclosure filing. Delaware, South Carolina, Illinois, and Nevada weren't far behind, each with roughly 1 in 250 or so homes seeing some kind of foreclosure activity. This isn't just one bubble state finally popping, it's broader than that. The common thread is pressure on household budgets, high prices, rising insurance, higher taxes, and shakier job stability are all combining to squeeze owners in those areas. So what does rising foreclosure activity do to neighborhoods? Foreclosed homes don't behave like normal listings. Many are behind on maintenance, peeling paint, aging roofs, worn-out systems. Banks or distressed owners usually price them to move quickly, not to squeeze out every last dollar. That means they often sell at a discount compared to similar, well-kept homes in the same area. When enough of those discounted sales show up in the data, they start pulling down appraisals. So even if you're a solid owner, making your payments and taking care of your property, a few distressed sales on your block can still drag on your home's value. For buyers and investors, that can look like opportunity. I can get a deal here. For existing owners, it feels like erosion. Why is my equity slipping when I didn't do anything wrong? Both reactions can be true at the same time. Now zoom out to the broader economy. When a household is under financial stress, they don't just struggle with the mortgage. They start cutting back everywhere else. Eating out, travel, shopping, kids' activities, and local services. If a family cuts $1,000 a month from their spending, that's $12,000 a year that no longer flows to local restaurants, hair salons, mechanics, tutors, gyms, and small businesses. Multiply that by tens or hundreds of thousands of stressed households, and you start to feel it in job growth, business profits, and hiring decisions. A lot of this doesn't show up in big national numbers right away, but it's very real on the ground. That's why foreclosure data is more than just a niche housing statistic. It's an early warning sign for the wider economy. There's also a shadow housing market most people don't see: extended stay hotels and motels. Over the last few years, the extended stay segment has become one of the strongest parts of the hotel business. These people aren't tourists. Many of them are living in those rooms because they can't get into or can't stay in traditional housing. So they end up in extended stay hotels, paying the equivalent of $2,700 to $3,600 a month or more for a single room with limited cooking options and no real tenant protections. It's often more expensive than a typical rental, but easier to get into because you pay by the night or week instead of signing a year-long lease. That's the shadow housing system. People who are still working and still paying, but are no longer inside the official rental or ownership world. On the other side of the spectrum, there's another slow-moving force: inherited homes. Baby boomers hold a massive amount of housing wealth, and over the next decade or two, millions of those homes will be passed down to children or other heirs. That sounds like a huge positive, a big wealth transfer, but that is not the reality. Surveys show most people who expect to inherit a home don't plan to keep it forever. Many say they'll eventually sell rather than move in. But if they're already stretched financially, they might not be able to afford to carry the property for long. That puts them under pressure to sell quickly, and quick sales often mean discounted prices. Multiply that across millions of inherited homes over time, and you get another potential source of downward pressure in certain markets, especially older suburbs and areas with aging populations. This inheritance wave will add inventory, but it may not be neat or orderly. It could show up as many must-sell listings that help buyers but add stress for existing owners. There's one more piece that's easy to miss. How many homes are now effectively uninsured? A Lending Tree study found that about 13.6% of owner-occupied homes in the U.S., nearly 1 in 7, are essentially uninsured, meaning they're paying less than $100 a year for coverage. That comes to roughly 11.3 million homes, and in some states, the uninsured share is above 20%. Sometimes this happens because owners paid off their mortgage and dropped coverage to save money. Other times, insurers pulled out of a state or raised premiums so much that people simply couldn't keep up. What do you do with all of this? If you're a homeowner, start by knowing your true monthly cost. Add up everything: mortgage, taxes, insurance, HOA dues, utilities, and a realistic monthly maintenance budget. If that total already feels tight with your current income, don't ignore it. Shop around and push back where you can. In many places, you can appeal your property tax assessment. You can also shop for your homeowner's insurance and adjust coverage and deductibles in a smarter way. And have a what-if plan. Ask yourself how many months you could realistically keep the house if you lost your job. If the answer is not many, consider building extra savings, adding a side income, or even downsizing from a position of strength. If you're trying to buy, don't just ask, "Can I qualify?" Ask, "Can I breathe?" Lenders approve you based on today's numbers. You need to consider future tax increases, higher insurance premiums, and routine maintenance costs. Run the numbers with a cushion, not right at the limit. Be picky about where you buy. A house that looks cheap in an area with rising foreclosures, high insurance, and aging infrastructure may come with headaches that aren't obvious in the listing. Sometimes paying a bit more in a truly stable area is actually safer. If you're an investor, watch local jobs and foreclosures together. A market with slowing job growth and rising foreclosure activity is one where your future tenants might be more fragile than your spreadsheet assumes. Underwrite using current numbers for taxes, insurance, and repairs, not what those costs looked like 5 or 10 years ago. If the deal only works with best-case assumptions, it's probably too tight. The big takeaway is this: foreclosures are rising again, not because homes suddenly became worthless, but because keeping them has become harder. Wages, insurance, taxes, and housing costs are no longer moving in sync, and that gap is where the stress lives. If you found this breakdown helpful, subscribe to Housing IQ, and let us know in the comments what you're seeing in your area. Your stories help shape what we cover next.